Okay, picture this. You're watching a stock you own, right? And it's climbing higher, higher. You feel pretty good, maybe even a little proud.
Sure, that little dopamine hit.
Exactly. Then maybe it dips just a tiny bit and boom, your gut just tightens. What do? Well, research shows there's this really powerful, often, let's be honest, irrational force at play. Did you know that survey data actually confirms almost half of investors cite the fear of losing money, not greed, fear, as their top emotional driver?
That's fascinating, isn't it? Fear over greed.
It is. And this fear, this like a primal aversion to loss, it leads us to make decisions that just defy simple logic, like, stubbornly holding on to investments that are sinking,
Right, hoping they'll come back.
while being super quick to sell the ones that are actually doing well, only to watch them keep climbing after we've jumped ship. It sounds totally backwards.
And often it is backwards. What's really fascinating there is exactly that paradox. You expect financial decisions to be, cold, hard calculations.
More numbers, yeah.
But human psychology is just so deeply embedded in the process. It's a powerful reminder, really, that the market isn't just some machine driven by numbers.
No, it's people.
It's a complex ecosystem driven by people with all their, inherent biases and emotions.
Absolutely. Welcome to the Deep Dive. Today, we're diving deep into exactly that intersection, exploring a field that has, well, it's really revolutionized how we understand finance, behavioral finance.
It really is.
Our mission in this deep dive is to unpack why investors, particularly based on the sources we're looking at, often make decisions based more on intuition, on emotion, rather than pure analytical logic.
Gut feelings instead of spreadsheets sometimes.
Totally. We've got a stack of material here,
Yeah.
Academic articles, research papers, industry reports that really shine a light on these psychological pitfalls. We're going to identify the key concepts, really dig into the most common and impactful biases, understand their very real consequences for your portfolio,
That's the key part.
and crucially, explore the strategies these sources suggest we can actually use to try and overcome them. Think of it as a shortcut, maybe, to understanding the hidden forces shaping the markets and, your own financial future.
Yeah, it's about peeling back those layers, isn't it? Understanding the why behind investment behavior that might otherwise just seem puzzling or even self-sabotaging. By the end of this deep dive, you should hopefully have a much clearer picture of the psychological landscape you're navigating as an investor.
Okay, let's start with the basics then. What exactly is behavioral finance? It's a term you hear thrown around a lot, but what does it really, encompass?
Right. So at its core, behavioral finance is a field that kind of emerged as a counterpoint to traditional economic theory.
Okay.
See, traditional economics often works under this big assumption that people are perfectly rational economic agents. These idealized beings who process all available information flawlessly.
Like stock investing.
Exactly. And make decisions solely to maximize their own utility or wealth. Behavioral finance challenges this. It examines how psychological factors, cognitive biases, emotions actually influence financial decisions in the real world. It acknowledges that while humans are fallible, we're prone to systematic errors in judgment, and we're driven by a lot more than just cold logic.
All right.
Our sources, like the material from William and Mary, they confirm this. It's basically the study of the impact of psychology on the behavior of investors and financial markets.
So a behavioral bias in finance.
Yeah.
It isn't just like a random mistake. It's a systematic one, predictable almost.
Precisely. A behavioral bias is a systematic pattern of deviation from rationality and judgment. In finance, our sources, places like William and Mary, Morgan Stanley, Qt Analytics, they define it as the way cognitive and emotional biases affect an investor's ability to process information accurately and make purely rational economic decisions. It's not that we can't be rational, but that our brains have these built-in shortcuts, right? Heuristics, emotional responses that can lead us down predictable, sometimes irrational paths, especially when we're faced with complex financial decisions and, lots of uncertainty.
Like mental shortcuts that sometimes lead us off the path.
Exactly. As Morgan Stanley points out, humans simply don't process all available information. We filter, we simplify, and we definitely bring our emotions to the table.
And it sounds like there are quite a few of these mental shortcuts or biases that can Trip us up.
Oh, more than you might imagine. One of our sources, Morgan Stanley, notes that there are over 150 documented behavioral biases that can influence our decision making.
Wow, 150.
Yeah, and not just in finance, but in all areas of life. Thinking about that number, over 150 distinct patterns of irrationality or deviation from logic, it really gives you a sense of the complexity of the human mind, right?
Hmm.
And how many potential pitfalls exist when we're dealing with money and markets.
Over 150.
Yeah. Yeah, wow. That makes trying to be a perfectly rational investor seem like a pretty impossible task.
It certainly highlights the challenge. But the key takeaway here, and sources like William and Mary really emphasize this, is that understanding these biases is absolutely crucial.
Okay.
It's probably not about eliminating them entirely. That might be impossible, like you said. But it's about recognizing their potential influence. Awareness is the fundamental first step towards developing sound investment strategies and, maintaining long-term financial stability.
Right.
If you know what forces might be pushing you, you're just better equipped to resist or counteract them.
That makes a lot of sense. It's like knowing the currents in the ocean before you start swimming. So if we look at the core emotional forces driving investors, what do the sources point to as the biggest triggers? What really gets us going?
Yeah, well, there's a very recent study cited in our material conducted by eToro, actually, between February and March of 2025. They surveyed 10,000 retail investors across 12 countries, specifically to identify the emotional drivers behind their investment decisions. 10,000 investors, wow.
Yeah, and the findings are quite revealing. They really reinforce some of these fundamental principles of behavioral finance we're talking about.
Okay, so what tops the list? What was the biggest emotional driver?
The overwhelming number one, cited by 43% of the investors surveyed, fear of loss.
Fear of loss? Not surprised, maybe, but still striking.
It is. This is the fear of seeing their investment values decrease, right? Of losing the capital they've put into the market. Think about that for almost half of investors. Avoiding pain is a stronger driver than seeking gain.
43%. That statistic alone tells such a powerful story. What was the second most cited driver then?
Coming in second, but significantly lower, was optimism, cited by 31% of investors.
Okay, so hope.
Exactly. This is the hope or expectation that investments will perform well, increase in value. So you've got fear of loss as the dominant negative driver, and optimism as the dominant positive one.
Fear and hope, a classic motivators. But that fear seems to have a much stronger grip, according to this data anyway.
It certainly seems so, globally speaking.
What other emotions made the list? Were there others?
Yeah, the survey listed several others that play a role, though maybe to a lesser extent on a global average. Excitement and impatience were both cited by 18% of investors.
Okay.
Overconfidence came in at 15%, greed at 14%, and then panic and the infamous fear of missing out, or FOMO, they were both cited by 12%.
FOMO, that's an emotion you hear so much about, especially with fast-moving markets or things like crypto. It's actually surprising it's relatively lower down the list compared to that fear of loss.
It is surprising to some, definitely, especially given all the media focus on retail speculation maybe being driven by FOMO. But this specific eToro data suggests that for a really broad base of retail investors across multiple countries, that deep-seated fear of loss, FOLO, is a much more pervasive and significant emotional influence than the fear of missing out on potential gains, FOMO. It kind of challenges the stereotype that retail investors are solely driven by chasing quick, exciting returns, doesn't it? It suggests there's this strong underlying motivation just to protect their capital.
That's a really crucial distinction, actually, and something important for listeners to consider about their own motivations, right? What's really driving you?
Exactly.
Did the survey reveal any interesting geographical differences in these emotions? You said 12 countries.
Yes, it did. And the geographical breakdown is quite insightful. It shows how local market conditions or maybe even cultural factors might amplify certain emotions.
Okay, like what?
Well, while fear of loss was number one globally, it was particularly pronounced in Italy. A striking 61% of Italian investors cited it.
61%, yeah.
British investors, on the other hand, they showed a higher propensity for optimism compared to the global average that was at 36%. Spanish investors were the highest in citing overconfidence at 23%.
Yeah.
French investors led in greed at 41%, which is way higher than the global 14%. German investors were most influenced by impatience at 25%. And interestingly, Australian investors reported the highest levels of excitement at 23%.
That's fascinating how where you live might actually shape your emotional investment profile.
Wild. Okay, let's take that number one driver, fear of loss. and really dive deep into that one because it's not just about being a bit nervous, is it? It's really the foundation of a very specific, very powerful bias.
Precisely. Fear of loss is the feeling, the raw emotion that underpins one of the most powerful and empirically documented biases in behavioral finance, loss aversion.
Loss aversion, okay?
Sources like Magellan and Qt Analytics clearly define this. It's the phenomenon where the psychological pain, that negative feeling associated with a loss, is felt more intensely, sometimes people say twice as intensely, than the pleasure or the positive feeling associated with an equivalent gain.
Ouch. Yeah, that resonates. Finding a $100 bill feels good, sure. But losing a $100 bill, that feels significantly worse.
Exactly. That's loss aversion in a nutshell. So how does this visceral feeling, this loss aversion, actually manifest itself when we make investment decisions?
Well, loss aversion is the emotion that makes it incredibly difficult psychologically to sell an investment that has gone down in value.
Right, because selling makes it real.
It makes the loss real. As Qt Analytics notes, it's the emotion that prevents investors from unloading unprofitable investments because doing so crystallizes the loss. It turns what was maybe a temporary paper loss into a permanent, painful reality. Holding on allows you to maintain the hope, however faint, that it will eventually come back to where you bought it, right? So you avoid that painful admission of making a mistake.
And this holding on to losers, this resistance to realizing a loss, that leads directly to what's known as the disposition effect, right? I've heard that term.
Absolutely. The disposition effect is a direct consequence of loss aversion and also a cornerstone of Kahneman and Tversky's prospect theory, which, fundamentally changed how we understand decision-making under risk. The disposition effect is simply the well-documented behavioral tendency for investors to hold on to losing investments for too long while selling winning investments too quickly. You hang on to the stocks that are underperforming, hoping they'll recover, but you're quick to take profits on the stocks that are doing well, maybe out of fear that those gains will just evaporate.
Hold on to the stones, sell the gold. It sounds so counterintuitive when you say it like that, and potentially very costly.
Yeah.
Tell us more about prospect theory. How does it explain this specific behavior?
Right, prospect theory is really groundbreaking stuff. It explains how people choose between risky alternatives, especially when probabilities are involved. Now, unlike traditional utility theory, prospect theory suggests that people don't evaluate outcomes in terms of their absolute wealth.
Like my total net worth.
Exactly. They evaluate them in terms of gains and losses relative to a specific reference point. And that reference point is typically the purchase price of an asset.
Okay, so it's all about how much I've gained or lost relative to what I paid for it, not my overall financial picture.
Precisely. That reference point is absolutely critical. Now, the theory suggests people behave as if they are maximizing an S-shaped value function, not just a simple linear utility function.
An S-shape.
Yeah, an S-shape. And this S-shape has two key characteristics that are really relevant here. First, it's concave in the domain of gains.
Concave, meaning it flattens out.
Exactly. It means the pleasure from a gain increases, but at a decreasing rate. So going from a $10 gain to a $20 gain feels like a pretty big jump, right?
Yeah.
But going from a $100 gain to a $110 gain, it feels less significant, even though it's the same $10 increase. Because of this concavity, when you're faced with potential gains, people are typically risk averse.
Oh, okay.
They prefer a sure gain over a potentially larger but uncertain gain. This contributes to selling winners. Quickly taking that sure profit feels better than risking it disappearing.
Like taking that $50 profit on a stock now, even if there's a chance it could go up to $100 tomorrow, you just lock it in.
Exactly that. Now, the other side of the S-shape is that it's convex in the domain of losses.
Convex.
Yeah.
So it gets steeper. No, wait.
It means the pain from a loss also increases at a decreasing rate. So going from a $10 loss to a $20 loss feels terrible, a big jump in pain.
Right.
But going from a $100 loss to a $110 loss, it doesn't feel that much worse than the $100 loss already felt. The difference feels smaller. Because of this convexity, when people are faced with potential losses, they actually become risk-seeking.
Risk-seeking. When facing losses. That seems backwards.
It does, but think about it. They're willing to take on more risk, hoping to avoid realizing loss entirely, perhaps just to get back to that original reference point, that purchase price. Break-even feels better than locking in a loss.
So if a stock is down $50, I might actually be more willing to gamble on it coming back up, maybe even buy more shares,
Yeah.
rather than just selling and taking the $50 hit.
That's precisely the behavior prospect theory predicts. You become willing to take on more risk, like holding on or doubling down, to avoid locking in that loss. And critically, as we mentioned with loss aversion itself, the S-shape is steeper for losses than for gains. That's the core of it. The pain felt from a loss of a certain size is greater, psychologically, than the pleasure felt from a gain of the exact same size. This asymmetry is what really drives the disposition effect.
Got it.
As Odine's paper explains it, if a stock you own appreciates, its price is in that risk-averse concave part of your value function, making you more inclined to sell and lock in the gain. If it declines, it's in the convex risk-seeking part, making you more inclined to hold on, even if the company's prospects have actually worsened, just hoping to get back to break even.
This isn't just like a neat theory, though, is it? There's actual hard evidence that investors really behave this way.
Oh, absolutely. And the Odin study from 1998, it's a classic. It analyzed over 10,000 individual brokerage accounts between 1987 and 1993, and it provides some of the most compelling evidence for the disposition effect in the real world.
10,000 counts again. So what did they look for?
Odin looked at every single instance where an investor had an opportunity to sell a stock they owned. He compared opportunities to sell stocks that were showing paper gains versus those showing paper losses. He calculated two key metrics. First, the proportion of gains realized, PGR essentially. For all the stocks the investor owned that were currently showing a gain, what percentage did they actually sell on a given day?
Okay.
And he compared that to the proportion of losses realized, PLR. So for all the stocks showing a loss, what percentage did they sell?
So basically, how often did investors actually pull the trigger on selling a winner versus pulling the trigger on selling a loser, given the chance?
Exactly. It measures action relative to opportunity. And the findings were remarkably consistent and really strong. Across all 10,000 accounts in that entire 6-year period, investors realized their gains significantly more readily than their losses.
How much more?
The average ratio of PGR to PLR was over 1.5.
1.5.
Yeah. What that means in practical terms is, on any given day, a stock that was trading above its purchase price was over 50% more likely to be sold by the investor than a stock that was trading below its purchase price.
50% more likely to sell a winner than a loser? That's a staggering number when you really think about it. It completely flies in the face of that classic investment advice, right? Cut your losses and let your winners run.
It absolutely does. And Odin was thorough. He went further to try and rule out alternative, maybe rational explanations.
Like what?
Well, he considered if investors were just rebalancing their portfolios, trimming winners that got too big, or maybe if higher transaction costs for low-priced, losing stocks were a factor, making them harder to sell.
Right.
But his analysis showed the disposition effect still held even when controlling for these factors. He also found something interesting. Investors were actually more likely to buy more shares of stocks that were down compared to those that were up. So PLPA proportion of losses purchased again was higher than PGPA proportion of gains purchased again.
Buying the dip, basically.
Kind of, yeah. And that aligns perfectly with the risk-seeking behavior in the domain of losses predicted by prospect theory. And it runs counter to the idea that just trading costs were the main reason for avoiding selling losers.
Okay, that makes sense. But what about tax strategies? People often talk about selling losers at the end of the year, right? For tax loss harvesting.
That's a critical point. And the study clearly showed its influence. Investors were significantly more willing to sell losers and less willing to sell winners, specifically in December compared to the rest of the year. That PGR to PLR ratio, which averaged over 1.5 annually and even peaked at 2.1 in January, meaning winners were more than twice as likely to be sold.
Wow.
It dropped dramatically to 0.85 in December, below 1.
So in December, they were more likely to sell losers than winners.
Correct, which is powerful evidence that tax incentives can, at least temporarily, override this ingrained behavioral bias. But the key is, for the other 11 months of the year, the disposition effect bias was clearly the dominant force.
So tax season aside, our natural tendency is to hold the losers and sell the winners. But here's the million-dollar question. Did this behavior actually cost investors money? Did the winners they sold tend to keep going up and the losers they held tend to keep going down, on average?
This is perhaps the most impactful finding of the entire study. Odin tracked the performance of the stocks after the investors made their decision either to sell a winner or to hold on to a loser.
Okay, what happened next?
The results were pretty unequivocal. The winning investments that investors chose to sell continued to significantly outperform the losing investments that they chose to keep holding on to.
Really?
Yes. Over the following year, that's 252 trading days, the stocks that investors sold for a gain had an average excess return, meaning performance above market benchmarks, of a positive 2.35%.
Okay, decent performance after they sold.
In contrast, the stocks that investors held onto while showing a paper loss had an average excess return of a negative 1.06%.
Ouch. So they underperformed the market.
They did. That's a performance difference of 3.41% over just 1 year between the group of stocks they decided to exit and the group they decided to stay in.
Okay, let me make sure I've got this straight in my head. The stocks they got rid of because they were up. They kept going up, outperforming the market.
On average, yes.
And the stocks they kept because they were down, they kept performing poorly relative to the market.
On average, yes.
So the very behavior driven by loss aversion, selling winners, holding losers,
Yeah.
actually led them to prune the good trees and water the dead ones on average.
That's a great analogy, exactly. The study provides strong empirical evidence that the disposition effect, on average, leads investors to make systematically mistaken decisions that negatively impact their returns. It wasn't just some neutral pattern of behavior. It was genuinely costly behavior.
Wow.
Odin even quantified a hypothetical economic cost. Imagine an investor, right? Faced with the choice of selling either a winning stock or a losing stock, and both positions are currently worth $1,000. Selling the winning stock first means foregoing a potential immediate tax saving. Let's say the capital gains tax rate is 15%, and they could have used the loss from the other stock to offset gains. By selling the winner, they lose out on potentially $130 in immediate tax savings they could have gotten by selling the loser instead.
Right, the tax benefit of the loss.
Exactly. And on top of that, based on the study's subsequent performance data, the stock they held onto, the loser, would earn approximately $34 less over the next year than the stock they sold, the winner.
So just by giving into the disposition effect in this one single $1,000 decision selling the winner instead of the loser, they could potentially be costing themselves around $164 over the next year. $130 in lost tax benefit plus $34 in foregone performance.
That's the calculation from the source. Yeah.
It's roughly a 4.4% hit on the position's value in just 12 months, purely due to this one behavior bias kicking in at the wrong moment.
That calculation really vividly illustrates the tangible, measurable economic cost of succumbing to the disposition effect for an individual investor. It's not just some abstract psychological concept. It directly impacts your wealth accumulation over time. Seriously.
Wow. Okay. That puts the cost of that bias into really stark relief.
Uh.
So if holding on to losers is one major pitfall, what's another common bias our sources highlight? Something else that leads us astray.
Another really significant one is the overconfidence bias. This comes up in sources like William and Mary and Magellan. It basically occurs when investors overestimate their own abilities, their knowledge, the accuracy of their predictions, or maybe even their ability to control outcomes.
This one feels very human, doesn't it? We all kind of like to think we're pretty good at things.
We absolutely do. And the statistics are quite telling, actually. Our sources give some great examples from outside finance that really highlight this tendency. The American Automobile Association, AAA, found that a striking 78% of Americans believe they are better than average drivers.
78%? That's mathematically impossible, right?
Exactly. By definition, only 50% can be above average. And in the investing realm, research from FINRA found that 64% of investors believe they have a high level of investment knowledge.
So most of us think we're financial rock stars and driving aces all at the same time, completely defying statistical averages. How does this inflated self-assessment actually hurt our investment decisions?
Well, overconfidence can lead investors to do a few problematic things. They might take on excessive risk, thinking they can handle it or that they've picked a sure thing. They might trade too frequently, churning their account and driving up transaction costs because they think they can time the market perfectly. They might insufficiently diversify their portfolios, putting too many eggs in one basket because they're so sure about their pick. Or they might just fail to do adequate research because they believe their initial instincts or, limited information are sufficient.
If you're overly confident, why bother digging deeper, right?
Exactly. If you're overly confident in your ability to pick winners or time the market, you're just much more likely to make big bets based on insufficient analysis or to completely dismiss warning signs that contradict your rosy view.
And I imagine this links pretty closely to only seeing what you want to see,
Yeah.
like ignoring the bad news.
Absolutely. Overconfidence is often reinforced and, frankly, exacerbated by confirmation bias.
Confirmation bias.
Okay. Which is the tendency we all have to search for, interpret, favor, and recall information in a way that confirms or supports our prior beliefs or values.
Right.
So, if you buy a stock based on a certain belief, maybe you think this company's technology is the future, you are naturally more likely to seek out and pay much more attention to news articles or analysis that validate that belief, while unconsciously ignoring, downplaying, or finding flaws in information that contradicts it.
So the more confirming evidence you find, even if you're actively filtering out the other side, the more confident you become.
Precisely. As Magellan notes, encountering consistent evidence that supports your choices, even if you're selectively seeking it out, can lead to this really inflated sense of certainty. It can create an illusion of infallibility.
Ooh, dangerous words.
Very. You become convinced you just can't be wrong, which then fuels the overconfidence and potentially leads to even bigger, riskier bets down the line.
Okay, so we're prone to holding losers, selling winners, and thinking we're much better at this than we probably are. What about the desire to just do what everyone else is doing, that pull of the crowd?
Yes, that's the herding bias or the herd instinct. It's discussed by sources like Magellan and EBC, and it's related to what AMP calls the pressure for conformity. Basically, it's the tendency for individuals to follow and mimic the actions of a larger group,
Right.
even if those actions might contradict their own research, their own information, or even their own gut inclinations.
Why do we do this? Is it just social pressure? Like not wanting to be the odd one out?
It's multifaceted, really. It's driven by factors mentioned in sources like AMP. Things like interaction with friends or peers, what are you buying, what are you selling? Comparing your investment performance to others, like benchmarking.
Keeping up with the Joneses portfolio.
Kind of, yeah. And there's a certain psychological safety in numbers, isn't there? If everyone else is doing it, well, it must be right. Or maybe even more powerfully, if it goes wrong, at least you're not alone in your mistake.
Misery loves company.
Exactly. There's a perceived reduction in personal responsibility when you're just following the crowd. It can also stem from a genuine, though often misplaced, belief that the herd somehow has better information than you do.
Okay. Where do we see this kind of behavior actually manifest in the markets? Can you give some examples?
Oh, herding can be observed across all sorts of markets, and EBC provides some good examples. In the Forex market, the currency market, herd mentality can trigger massive currency movements that aren't necessarily justified by the underlying economic fundamentals.
Right.
Traders might see others rushing to buy or sell a currency based on maybe just a headline or an influential analyst call, and they just jump in. That creates momentum that feeds on itself, even if the long-term economic picture doesn't really support the move.
Okay. What about commodities, like oil or gold?
Yeah, in commodity markets, herding can significantly amplify price swings. You get these fear and greed cycles, often triggered by geopolitical events or inflation concerns. They can lead to rapid collective buying or selling that kind of disregards the actual supply and demand dynamics.
For example?
For example, a sudden panic about a potential oil supply disruption. Maybe a conflict flares up somewhere. Even if the actual supply hasn't changed yet, it could lead many traders to buy oil futures simultaneously. They do it out of fear of missing out on a price spike, or maybe fear of being left behind if prices soar.
Right.
This collective action then causes the price spike, which validates the initial fear and just draws in more herding behavior. It becomes a self-fulfilling prophecy.
And in stock markets, how does it play out there?
In the stock market, herding can lead to big overreactions to news, like earnings reports or company guidance updates. If a few big players or maybe some influential analysts react negatively to a company's results, the herd might quickly sell off shares, pushing the price down way beyond what the fundamentals might actually warrant.
Just because everyone else is selling.
Just because everyone else is selling. The fear of being the last one holding the bag reinforces the selling pressure. And of course, the same thing happens on the upside. Positive news can trigger similar rushes to buy, pushing prices maybe too high, too fast.
Is there a prominent, maybe more recent example that really illustrates this kind of herd behavior in action?
Well, EBC points to the GameStop GME rally in early 2021 as a really significant modern example, and one that was massively amplified by social media.
Oh, yeah, I remember that. That was wild.
It was. It involved this very large, kind of uncoordinated but directionally aligned group of retail investors who basically organized themselves via online forums like Reddit to buy shares of GameStop. And This collective, concerted buying effort, driven largely by shared sentiment, social proof, maybe some anti-establishment feelings, excitement, that sense of collective action rather than traditional fundamental valuation.
Definitely not fundamentals.
No. It led to this unprecedented and, frankly, abnormal price spike that fundamentally disrupted the typical market dynamics for that stock for a while. The source highlights this as a powerful illustration of how, in the modern era, technology and social connectivity can just amplify herd behavior to an extreme degree.
That's a really powerful illustration of how quickly information, and maybe more importantly, emotion can spread and drive collective action today. Okay, so we've covered loss aversion and the disposition effect, overconfidence, and herding in some detail now, but our sources mention several other biases that also contribute to these less than rational investment decisions. Let's maybe briefly touch on some of the others you identified.
Certainly. Yeah, there are quite a few more that can subtly or sometimes significantly influence our choices. Qt Analytics brings up regret aversion.
Regret aversion.
This is the anticipation of regret. It's not just feeling regret after a decision has gone wrong, but actively making decisions now specifically to avoid feeling regret later.
How does that play out?
Well, it can lead investors to hold on to loss-making investments precisely to avoid the feeling of regret they would experience if they admitted they made a bad decision and sold. They fear the regret of selling at the absolute bottom, or maybe the regret of selling a loser only to watch it miraculously recover right after they sell.
So you stay stuck in a bad situation just to avoid the potential feeling of admitting you made a mistake. That sounds like a really painful loop to be in.
It can be, yeah. Another interesting bias from Qt Analytics is mental accounting.
Mental accounting, like bookkeeping in your head?
Kind of. It's how investors subjectively value and categorize money, often leading to detrimental results. We tend to put money into different mental buckets, right? And we treat those buckets differently. Even though money is fungible, a dollar is a dollar.
Okay, give me an example.
Well, we might treat, say, gains from an investment as house money or play money and be much more reckless with it.
Yeah, I've heard that.
While being very conservative with money earned from our salary, our hard-earned money. Or we might be really reluctant to sell a losing stock from one account, but easily sell a winner from another account, even if it makes absolutely no sense from an overall portfolio perspective. The Qt Analytics study found this bias, along with things like age, monthly income, and investment experience, significantly impacted investor behavior and often led to suboptimal decisions.
So the way we mentally label money actually impacts how we treat it, regardless of its actual objective value. What else is on the list?
AMP highlights extrapolating the present. This is our tendency to assume that recent trends will just continue indefinitely into the future.
Right, this time is different.
Exactly. Or maybe this trend will last forever. We tend to downplay uncertainty or the possibility of change. If the market has been soaring for a while, we start to believe it will always soar. If a particular sector, like tech, has done incredibly well, we assume its growth is just unstoppable. This leads to chasing performance, buying high, and then being caught completely off guard when trends inevitably reverse, as they always do. Related to that is overweighting personal experience, also from AMP. This involves giving undue weight to recent or maybe spectacular or just deeply personal experiences when we assess probabilities or make decisions.
So if something big happened to me recently.
Right. If you personally had one stock that went up, say, 1,000%, you might irrationally start to expect every stock you pick to have that kind of potential, and you might dismiss more grounded, realistic analysis. Or, conversely, if you had a really terrible experience with a specific type of investment, maybe you lost a lot in crypto, you might swear it off forever, even if the market conditions or the specific risks that led to your loss have completely changed. It leads to this emotional involvement with investments based purely on your individual history rather than objective analysis of the present situation.
So one big win or one big loss can completely warp your perception of future possibility.
It really can. Magellan adds the endowment effect.
Endowment effect.
This is the tendency we have to overvalue something simply because we own it. Once you own a stock, it becomes yours. You often develop an emotional attachment, or you just place a higher value on it than you would if you were evaluating it objectively as a potential new investment.
Like my stocks are special.
Kind of, yeah. And this can make it much harder to sell, even when the fundamentals are clearly suggesting you probably should. Magellan also mentions neglect of probability. This is where we overlook or misjudge the actual probabilities of different outcomes happening. We might focus too much on single, most likely estimates, like an analyst's price target, and ignore the whole range of possibilities. And sometimes we overemphasize those low probability, high impact events that get a ton of media attention, the so-called black swans.
Right, worrying about the asteroid hitting when maybe you should be focused on saving for retirement.
Exactly. You might focus solely on that single target price instead of considering the distribution of potential outcomes, or you might become overly fearful of some rare event that's dominating the news cycle, even if its actual probability is minuscule.
That really brings to mind that Warren Buffett quote you mentioned earlier, the one in the Magellan Source. The biggest mistake in stocks is to buy or sell based on current headlines.
It's a perfect fit, isn't it? Current headlines often sensationalize rare events or focus intensely on short-term volatility. They feed right into our neglect of actual long-term probabilities and encourage reactive emotional decisions rather than reasoned analysis based on fundamentals and, long-term goals.
Any others?
Just one more key one from Magellan. Anchoring bias. This is our tendency to rely way too heavily on the first piece of information we encounter, the anchor, when making decisions, even if that information is irrelevant or totally outdated.
Okay, like what in investing?
Well, a classic example is fixating on the purchase price of a stock. That becomes your anchor. You think of that as its true value, maybe even years later, regardless of how the company's performance or the market conditions or the entire industry might have changed. You're anchored to that initial price, and it affects all your subsequent decisions, whether to buy more, hold, or sell. You're always comparing it back to that anchor.
So, wow, we've got this really complex interplay of all these biases driven by fear, by overconfidence, by the crowd, by our own past experiences, even how we mentally categorize money, and what number we first saw. It's a lot to navigate. What are the ultimate consequences of all these psychological tendencies for investors? Why does all this behavioral stuff really matter to someone just trying to manage their money?
It matters immensely because, as William and Mary puts it pretty bluntly, these biases fundamentally inhibit an investor's ability to make objective, rational decisions. AMP describes them as leading to these lapses of logic in our financial habits.
And these lapses, they're costly, right? It's not just interesting psychology.
They are absolutely costly. Most directly, they lead to demonstrably costly investment mistakes. As we saw very clearly with the Odean study on the disposition effect, holding on to losers and selling winners isn't just some theoretical problem. It results in measurably lower investment returns over time. These biases can literally chip away at your portfolio performance year after year after year. And beyond the individual portfolio, these behavioral dynamics, when they become widespread across many investors, can significantly impact the broader market itself. As sources like AMP and Capital.com discuss, collective emotional decisions can magnify the impact of fundamental news. They can lead to excessive market volatility. They can fuel asset bubbles when optimism and herding drive prices far beyond any reasonable intrinsic value.
Right, like the dot-com bubble.
Exactly. And they can precipitate sharp, painful crashes when fear, panic, and maybe regret aversion finally kick in en masse. They contribute significantly to the booms and busts that characterize market history.
So it affects individuals and the whole system.
Absolutely. The consistent message from all these sources is crystal clear. Succumbing to these biases is not just an interesting psychological phenomenon. It has tangible, negative financial consequences, both for individual investors trying to reach their goals and for the overall stability and efficiency of the market.
That's a pretty stark picture. It really sounds like our own brains are often our biggest enemies when we're trying to invest. Given how deeply ingrained these biases seem to be part of human nature, almost can we actually do anything to fight them? Is there a way to become a more rational investor, or are we doomed?
No, we're not doomed. There is absolutely hope. The powerful message from sources like Magellan and Morgan Stanley is that while you probably can't eliminate these biases entirely, they're pretty hardwired.
Right.
You can certainly mitigate their impact, and the absolutely critical first step, the foundation for everything else, is recognition and awareness.
Just knowing about them.
Exactly. Simply becoming aware that these biases exist, understanding what they are, and then learning to identify the situations or maybe those internal feelings where they might be influencing your own thinking. That's half the battle right there. It's really about developing a level of self-awareness about your own psychological tendencies.
So just knowing about the bias, like loss aversion or overconfidence, is the starting point.
It's the essential starting point. Once you recognize that a bias might be at play, maybe you feel that intense reluctance to sell a stock that's dropped sharply, that's loss aversion talking. Or maybe you feel this irresistible urge to jump into something just because everyone on social media is talking about it, that's hurting. Magellan suggests you then have choices.
Okay.
You can consciously try to make an appropriate adjustment to your decision-making process, or, importantly, you can seek objective help from someone who isn't emotionally invested in the same way you are, like a trusted financial advisor.
Get a second opinion, basically.
Exactly. And the sources offer several really practical strategies you can use to build a defense against these biases. One fundamental piece of advice is to develop a detailed, preferably written, investment plan
A plan.
with specific, measurable financial goals. Magellan really stresses that a well-defined strategy acts as a roadmap. It's grounded in logic and your long-term objectives, not short-term emotion. This plan helps prevent those impulsive decisions driven by market noise, fear, or excitement. It gives you something objective to refer back to when your emotions are running high.
So make the important decisions about what you're trying to achieve and how you'll generally do it before you're in the heat of a market panic or frenzy.
Precisely. Plan in the cold light of day. Another crucial strategy, and this one is particularly effective against things like herding and confirmation bias, is to base your investment decisions on thorough, independent research and fundamental analysis.
Do your homework.
Do your own homework. Don't just follow market trends or headlines or what your friends are doing. Dig into the actual value and prospects of an asset yourself. And Magellan adds a great point here. To actively counter confirmation bias, you should proactively seek out information and perspectives that challenge your existing beliefs about an investment.
Look for the opposing view.
Yes, look for reasons why you might be wrong, not just reasons why you think you're right. It forces you to be more objective and consider the downsides.
Okay, that's tough, but makes sense.
It is tough. Regularly reviewing your portfolio is also important. And Magellan suggests establishing clear, predefined criteria for selling assets before emotions get involved.
Like setting rules in advance.
Exactly. Decide in advance, maybe when you first buy something, under what specific conditions you will sell it. Maybe it's based on its price hitting a certain target, or its performance lagging for a certain period, or maybe a specific negative change in the company's fundamentals. Having these rules helps you overcome that disposition effect, the urge to hold losers, and also the endowment effect, the attachment to things you own when the time comes to make a potentially tough decision about a winning or losing position.
Okay. What about using those sentiment indicators, like the fear and greed index?
Yeah, Capital.com suggests using tools like the Fear and Greed Index, but with a healthy dose of caution. These sentiment indicators can be useful to help you understand the prevailing crowd psychology. Is the market currently driven by extreme fear or extreme greed?
Right.
That awareness can be useful context, but you should not use it as the sole basis for your decisions. You need to combine it with your own analysis. They even propose considering a contrarian approach, sometimes potentially acting opposite to those extreme emotional swings. Maybe buying when sentiment is overly fearful, assuming your fundamental analysis supports it, of course, or perhaps trimming positions when sentiment gets overly greedy and euphoric.
So understand what the crowd is doing, but don't necessarily just join them blindly. Maybe even lean against it sometimes.
Right. Use that awareness of sentiment more to inform your risk management. As Capital.com notes, during periods of extreme sentiment and potential volatility, maybe you adjust things like your position sizes, or perhaps you set tighter stop-loss orders based on your own analysis, not just based on the crowd's feeling. Maintaining a strong focus on your long-term investment goals is another key strategy mentioned by Magellan. Keep the bigger picture in mind. Why are you investing in the first place? What are you saving for? A house, retirement, college. This longer-term perspective helps you ride out that inevitable short-term market volatility and the emotional swings that come with it. It prevents making impulsive decisions driven by immediate fear or greed that could totally derail your long-term plan.
And learning from history seems vital, too, based on what you said about booms and busts.
Absolutely. AMP really emphasizes the importance of learning from market history. Study past booms and busts. Understand how behavioral factors like herding, overconfidence, and panic have fueled them time and time again. Knowing that these cycles have happened before, driven by predictable human behavior, can give you crucial perspective when they inevitably arise again. It can help you avoid buying into euphoric tops or panic selling at fearful bottoms. It provides a much-needed dose of realism and detachment. And finally, Qt Analytics highlights the simple but powerful value of improving financial literacy and seeking training. The more you understand about market fundamentals, different asset classes, valuation methods, and crucially, behavioral finance itself, the better equipped you are to recognize your own biases and make more rational choices. Financial education really does empower you.
Yeah.
And as Magellan suggested earlier, don't ever hesitate to seek objective help from a qualified professional advisor. They can provide that detached, rational perspective, free from your personal emotional biases, especially when you're facing really important or complex financial decisions.
It really sounds like the path to becoming a more rational investor isn't necessarily about changing our fundamental human nature, because maybe that's impossible.
Probably is.
But it's more about building this robust framework around ourselves, right? A framework of planning, research, rules, perspective, and self-awareness, all designed to counteract our natural psychological inclinations when it comes to money.
That's the key takeaway, absolutely. It's about creating systems and habits that prioritize logic and long-term goals over those immediate, often counterproductive emotional reactions. It's definitely a continuous process, right, of learning and self-improvement. But the potential rewards in terms of better investment outcomes and just greater financial stability and peace of mind are really significant.
This deep dive has been incredibly insightful, I have to say. Really pulling back the curtain on these powerful, often hidden psychological forces that are always at play when we invest. We've seen how deep-seated factors like loss aversion, explained so well by prospect theory, lead directly to counterproductive behaviors like the disposition effect, holding on to losers while selling winners, and at a measurable cost to our returns. We've explored how overconfidence can lead us to take way too much risk, how the herd instinct can sweep us into irrational market movements, and we touched on so many other biases that create those lapses of logic in our financial habits.
And the sources make it really clear that these aren't just, interesting academic concepts. They have very real-world consequences, both for our individual portfolios and for magnifying volatility in the markets as a whole. They really help explain why making investment decisions can feel so challenging sometimes, and why our gut instincts often lead us astray.
And the most important lesson, the one echoed across pretty much all the material we looked at, is that awareness is the essential first step. Recognizing your own susceptibility to these biases, acknowledging that you, like almost everyone, have them, it's not a sign of weakness at all. It's actually a sign of strength.
Yeah, absolutely.
It's the necessary foundation that then allows you to start implementing the practical strategies we discussed, things like building a strong investment plan, doing your own independent research, and looking for opposing views. Setting clear rules for buying and selling before emotion strikes, maybe using tools to understand market sentiment without being controlled by it, maintaining that long-term perspective, and just continually educating yourself. It's really about deliberately constructing a decision-making process that supports your financial goals, rather than just letting your emotional brain run the show all the time.
Well said. It's a journey, right? Towards greater financial discipline and objectivity, one step at a time.
So maybe to leave you with a final thought based on everything we've explored today, if the research clearly shows that the winning stocks investors tend to sell actually continue to outperform the losing stocks they tend to hold on to, and this single behavioral mistake could be costing you measurably year after year, how much might your own behavioral blind spots be costing you right now, maybe without you even fully realizing it?
That's a powerful question.
And maybe more practically, what specific concrete step, perhaps just one of the strategies we discussed today, maybe it's writing down a specific selling rule for one stock you own right now, or maybe actively seeking out one article or viewpoint that contradicts one of your strongest investment beliefs. What one step could you take this week to start building that more rational framework for yourself?
Definitely something to consider as you reflect on your own approach to investing and think about the forces that are really shaping your decisions.
That's it for this deep dive. We really appreciate you joining us to explore the fascinating and sometimes frustrating world of behavioral finance.
Until next time, keep learning, stay curious, and definitely aim for objectivity in your financial decisions.